It was actually in 2000 that local government super decided it would not own shares in tobacco, but rather than restrict the mandates of our investment managers, we decided to exit out of these stocks through a long-short strategy. One of the prime reasons we used a long-short overlay was to measure the impact of negatively screening out selected industries. I suspect at the time we were considered one of the pixies in the garden, perhaps even more so when a couple of years later we added gambling, uranium mining, armaments and old growth logging. So why did we ban them? Yes, we believe that these were industries that are detrimental to the society we live in, and we wanted to take a leadership position. I'll return to this shortly. But fundamentally, we felt that these industries would face increasing regulatory scrutiny and the probability of an uncertain long-term future. In fact, local government super had already embarked upon the concept of ESG investing, taking into consideration the long-term environmental, social and governance risks in its investment decision-making framework. Admittedly, this was a fairly crude approach. It was predominantly industry-specific. With regard to the individual stocks themselves, we were fairly limited, and Nathan will actually recall in his previous life at Regnan how I came to him to see how we could obtain quality research on Australian stocks that ranked poorly on these ESG factors and those who ranked well, so we could incorporate the same long-term methodology or long-short methodology into our overlay for specific stocks. International shares were a challenge. The research is there, but the universe is much larger and the holdings widely dispersed. So one of the briefs when we employed our head of sustainability was to extend this long-short overlay into our international share portfolio without it becoming an overly elaborate, costly and time-consuming exercise. Clearly, fixed income presents an even bigger challenge. However, we've managed to incorporate an ESG overlay into our sovereign bonds through a specific mandate which ranked high government debt levels as an ESG risk. And this mandate can be measured very easily against an unconstrained government benchmark. So while our journey is not complete, we feel we've done most of the heavy lifting. Of course, the real test is with the performance numbers. I'm pleased to say that since its inception in 2000, our Australian overlay has returned 0.11% per annum, and an international overlay 0.04% per annum. If we had had the international overlay in place for the same period, I dare say the results would have been much the same. The sovereign bond portfolio has not performed as well. In fact, it is 8 basis points below the benchmark. But remember, this portfolio has only been in operation for less than 2 years, and it really performs well during tough credit conditions. So we would obviously have loved to have had it in place prior to the GFC occurring. I know these results are modest, but they are real. So let's not hide behind the argument that ESG investing will harm your returns. I now want to touch upon the leadership position that I mentioned earlier in my presentation. I'm genuinely surprised that large superannuation funds don't feel that they have some responsibility in this area. Do we really see ourselves as faceless financial institutions whose sole goal it is to make money? Members expect us to have a pulse and will over time call us into account. Let there be no mistake, NGOs will be increasingly targeting superannuation funds. Their members are our members. In fact, we received a number of letters from members around the time that Guns were looking to expand their operations into the pristine Tasmanian wilderness. Clearly, these members were being primed by organisations such as the World Wildlife Fund, but we were able to respond positively, showing how we had taken the stance to divest all of our shares in Guns. We were able to turn a potential negative into a positive. But being an active asset owner does not necessarily mean divestment. We're all too aware of the terrible situation in Bangladesh, where over 1,000 textile workers were killed in a factory fire, and the conditions that led to it. How many superannuation funds have even written to their major Australian retailers asking about their supply chain management? I can assure you that if a number of funds had done this, they would sit up and take notice. How would you respond if your members asked you, what have you been doing? You tell them your responsibility is simply to invest their money to make the best return possible? Now watch Twitter go into overdrive as your brand is trashed. Ultimately, ESG investing is for the true believers. That is, you accept that certain risks, whether they be environmental, social or governance, can affect the value of investments. These risks will more often than likely play over the longer term. But after all, are we not longer term investors of our members' money? The MySuper disclosure requirements are actually not the issue here. MySuper is for the disengaged member. But regardless of MySuper, funds should be disclosing their holdings. We are not Swiss banks. I see nothing wrong with a superannuation fund being required to have a good argument for why it invests, right down to the stock level if need be. There is no evidence to support the position that taking into account ESG considerations as part of your investment framework harms performance. In fact, given that the evidence is the opposite, I believe that you are risking your fiduciary duty by not doing something about it. We live in a world where you're coming under an increasing scrutiny. The rationale of where you draw the line is really nothing more than an excuse to do nothing. And by doing nothing, you are leaving yourself vulnerable to irreparable brand damage due to your passive endorsement of an unacceptable practice. This to me is poor risk management. Thank you.
A couple of brief remarks about the approach that CBUS takes to ESG and to divestment, and then I think we'll have some more time to follow up on some of these issues during the Q&A session. But I just wanted to put it into context and say that CBUS very clearly has a mainstream integration approach to ESG, which means that typically what we do is work through our external fund managers to encourage them to be considering the issues that we think are important and to be making sure that they're valuing those in their financial decision making. We also do a lot of corporate engagement and we vote our shares, and we see that as being very influential. And Peter was just referring to the Bangladesh issue, and certainly we've been doing a lot of work there. We have a strong belief in the power of a collective approach, so we work closely with AXI, with the Investor Group on Climate Change, and with other collaborative organisations within the space. But there are times when these approaches don't work. And so we have started to develop a framework to guide instances where we may need to divest. We don't think that this will be a common practice for CBUS. In fact, we have 2 divestments in place, which I'll talk a bit more about in a minute, and we don't necessarily anticipate in the near term that there would be any further issues on the horizon. The framework that guides us in thinking about when we might need to divest is where engagement, so that's our typical approach is engagement, but if engagement has failed or is not practical, where an investment poses an unacceptable reputation risk to the fund, and where investment involves a contravention of international conventions or treaties. So in those circumstances, we might decide to divest, but again, I just want to stress that that is the exception to our process rather than the norm. So we enacted a divestment on controversial weapons, being cluster munitions and landmines, about 18 months ago, and that was largely based on two of our framework issues, one being the fact that we felt that investment in those areas posed an unacceptable reputation risk to the fund. We didn't feel that we could happily publicly defend our investment in those companies manufacturing those weapons, and the other being that we were concerned about whether or not manufacture of those weapons and investment in those companies might contravene some international treaties and obligations. We just announced today a divestment of tobacco products, which is actually the companies that manufacture tobacco, so it's limited to those companies that manufacture cigarettes and smoking tobacco and so on. And the rationale behind that was that firstly that we believe there's no safe level of use for tobacco products, so used as intended, tobacco products kill. We think also that investment in tobacco opens CBUS to investment and reputation risk, because a lot of the premise on which tobacco profitability is built, we believe, is unsustainable, and that is that profitability for tobacco companies at the moment is really driven through the sale of and prompted addiction of young people in developing countries, where there is much less regulation and much less knowledge of the health implications of tobacco. We believed also that engagement is not an option, so we would argue that there's not much point in going to talk to tobacco companies to encourage them to cease their core business. And finally, our consideration also was the impact of tobacco products on our members, because over the last couple of years, 6.6% of our death claims have been from lung cancer death. And consider that lung cancer incidence increases dramatically with age, and the only members covered by our insurance are of working age, therefore presumably there are a lot more of them who go on to develop lung cancer after they leave the fund, or are no longer insured anyway. So you can see that there's quite a range of factors that went into this decision that we made. There wasn't just one single factor. And the final one that I'll mention was materiality. So CBUS is a fund of about 23.5 billion Australian dollars at the moment. We had about $24 million invested in tobacco products, and there just didn't really seem to be any point in continuing to have the exposure that we thought was a risk to us without having any materiality for the fund. I might come back to later, Nathan, there's an issue as well with divestment about just the structure of how you work and whether you work. I mean, the structure Peter talked about was interesting. We're just taking a straight sale approach, but the other issue is how much control you have over your portfolio, and when you decide to divest, that becomes very clear. So, for example, we have some investments still through pooled trusts in spite of our size, and we can't direct managers on those pooled trusts.
Thank you. Azhar.
Thanks, Nathan. So I guess for me, I would like to bring back the question of divestment to what I see as some fundamental principles or questions. And there are two questions in my mind. One is, is a divestment in the interests of your members, and does it benefit your members? And so if I look at it from the point of view that I'm a member of MySuper fund, so the fund and the investment managers that the fund employs are actually my agents, and they should be all acting in my interest, likewise for everyone else in this room. So all the agents in that chain should be acting in the interests of the ultimate beneficiaries in the fund. Any divestment decision, according to that logic, according to my logic, and happy to be challenged on that, should be in the interests of my risk-adjusted savings. So if my fund turns around and so let me give you some examples of what makes sense and what is probably borderline or doesn't make sense. The first thing is investment risk, which you touched on. So if a stock has peaked and the investment manager sees that the value of the stock is greater than the intrinsic value of the stock, they should divest. They should take profit, get out of it before the share price value starts dropping. Absolutely, that's a divestment decision that I would expect them to make, because it makes sense for me. It's in my interest for them to maximize my returns, and that's how they maximize their returns. If my investment manager is approached by a buyer who is offering more than what a stock is worth, they should divest, because that's in my interest again. They should be maximizing my returns, and they should be selling a stock if it's being offered at more value than they think it's worth. Now, the second element to this, if I'm a member, if I'm an activist member, or if I'm a member who has got certain views of where my money should be invested, let's say I don't want my money to be invested in coal. We can talk about coal as an example later on, but let's say simple, I don't want it invested in coal because coal is a dirty fuel. I don't want it invested in tobacco stocks or alcohol or gambling stocks, and that I have very clear expectations of where my money should go. Then the fund should, if a fund can provide a product, and if the investment managers can then provide service for that product, then that's fantastic. That's the investment managers and the fund are acting in my interest. They are divesting because I've requested them, I've required them, and expect them to divest out of those stocks, which I don't think are good stocks in my opinion. But if I'm invested in a product and I'm not aware, and I have not given any directions to the fund or the manager about divesting out of coal, and I find out that they've divested out of coal because in their view coal was a dirty fuel, or they had made other assumptions about coal, and that actually leads me to lose part of my savings because it turned out that they were wrong, or it turned out that I was not informed of their divestment or screening decisions, I wouldn't be happy. So it really comes back to, in my view, any decision that any agent is making down the chain on behalf of the members, is it in their self-interest or is it in the interest of members? When I talk about members wanting to divest out of companies based on ethical considerations, in my view, once you divest, you lose all your leverage. So we can talk about putting pressure on companies and engagement, and that's a good thing. But divestment is the point where you've fired your shot and it's gone. So from that point on, you've lost all pressure and you've basically given up. So it is symbolic for that exact reason, because once you've divested, you have no more influence over the company. You have no influence about changing any investment outcome. The other thing about why I think it's symbolic is that it actually doesn't, in many instances, it doesn't solve the problem. I might divest out of tobacco because I might not want my savings invested in a tobacco stock. Does it actually solve the problem of smoking in the developing world? I might divest out of cluster munitions because cluster munitions are very harmful weapons which cause civilian casualties long after a conflict has ceased. Does it actually solve the problem of ridding the world of cluster munitions? So coal, another example. I might divest out of coal, but does it actually solve the problem of global warming? If there was a totalitarian world government with one universal fund which was controlling all investments in the world, I would say yes, it would make a difference. But we don't live in that world. We live in a world where there are many, many funds and many, many investment owners competing with each other, And in that world, we have to look after our own interests, which should be aligned with the interests of our members. So it comes back to the same test, which is it in the interests of members?